I'm Charlotte McLeod with investingnews.com, and here today with me is Brien Lundin, editor of Gold Newsletter and host of the New Orleans Investment Conference. Thank you so much for being here. Great to have you.
Great to be with you as always, Charlotte.
Really excited to be speaking with you. And of course, we have a lot to talk about today when it comes to gold. But where I want to start with first is your upcoming event, the New Orleans Investment Conference, coming up in about 2 months now, and I am definitely getting excited to attend. So if we could begin there just by reviewing highlights for this year, people attending, different panels, things that you want investors to know.
Yeah, absolutely. Thank you. This is our 50th anniversary New Orleans Investment Conference, so we're pulling out the stops even more, although we do that. We're trying to do that every year. So that's one great reason to come this year, because we've got an extraordinary group of speakers this year, headlined by Jim Grant, and dozens more from Brent Johnson, Danielle DiMartino Booth, Rick Rule. Obviously, I'm reading from a list here. Doug Casey's virtual this year. We've got James Lavish, Jim Laurio, Jim Bianco, Lawrence Lepard, Peter Bookvar, just going on and on and on, dozens and dozens of the top experts out there. And I think that's kind of the bigger story as well. You know, it's always a great experience to come to the New Orleans Conference, and it always pays great dividends, literally and figuratively, so much so that we kind of pioneered the money back guarantee for an investment conference. If you don't feel it was worth every cent and many times over that you paid to attend, we refund your entire registration fee. You just have to let us know. So it always works in any year. But one thing people know through decades of investing is that if you're in a metals and mining bull market, this is the event that you absolutely can't miss, because this is where a lot of the biggest winners of the coming year are discovered. You know, the companies that go up 5, 10, even 20 or more times in value, they seem to, more often than not, have made their initial appearance or have been available at the New Orleans Conference in our exhibit hall. So it is the place to be to find great strategies and predictions and analysis from the macroeconomic picture and geopolitical picture, all the way down to individual stock tips from our faculty. And this year is going to be bigger and better than ever. And great to have you back as usual, getting lots of content from our speakers.
As I said, I'm really excited. This is one of my favorite events of the year, if that means anyone to people listening out there. And I do hope to see some of our audience members there as well. So we'll include all the details for that in the video description if people want to learn more. And we look forward to seeing you there in a couple of months. So moving over to what's going on in the markets right now. So as you said, this is a great time to be attending the conference. And just this past week, so we finally got our long-awaited Fed interest rate cut, and it came in at 50 basis points instead of just 25. So curious to start there and get your thoughts on what's going on. Is that a bold statement from the Fed, or is this a sign that they are now playing catch up?
Yeah, I think it was a hidden bold statement from the Fed. If there's anything, could be anything like that. You know, going into it, I thought that more important than what they did would be what they said. But in retrospect now, I think what was more important was what they did and what they didn't say. You know, initially when they announced the half-point cut, the markets cheered and they all rose and soared. And then once the black box algorithms had been done reading the statement, humans took over and said, half point, huh? What are they really saying here? Why are things so bad that instead of a quarter point, they went with a half point? And I don't think that message of fear and trepidation was one that the Fed had intended to be taken, but that's what happened, and the markets then, dropped and ended up the day in the red. Now, as we speak, the following day, everything's soaring again because markets and investors are reawakening today to the fact that this is an incredible shift from one of the harshest tightening episodes, and in the Fed's case, I think the harshest tightening episode in its history, to loosening, to easier money. And the key here is that the Fed, this is not just an off-the-cuff decision by the Fed. They are backed into a wall to do this by the monstrously large debt situation in the U.S., the huge and growing debt service payments, and something else perhaps that they're seeing in the data, whether it's a slowing employment or something else that might be indicating a recession. So going forward, I think the markets, the broader markets, stock market, et cetera, are cheering this easier money and back in that kind of speculative euphoric mode. But gold is in a unique spot here in that it will benefit no matter what happens. If things go, there's a no landing or a slow landing, and we are in an easier money environment, and real interest rates are dropping, then gold and the metals and miners are going to do quite well and keep up with stocks, I believe. But if we're going into a recession, then the stock market is going to crater because that's the new fear, is an economic slowdown with a stock market that is priced for perfection. So if we get signs of a recession, then the stock market is going to take a tumble, and barring a kind of a liquidity event crash, gold and metals and the miners are going to do even better if it looks like there's a recession impending.
What are your updated recession thoughts? I think yesterday, of course, we also got the comments from Powell, and overall, he seemed pretty pleased about where the economy is headed right now. So what are you thinking?
Yeah, I think there's a real risk of a recession. There are some smart people out there that I really respect that think we've been in a recession since for quite a while. And that a lot of that has been hidden by the jobs numbers. We had that nearly 900,000 jobs that kind of disappeared during the jobs revision. So the jobs numbers that we've been getting all year long are much worse than we had thought at the time. And in fact, all the stock market valuations, et cetera, have been largely based on those false numbers. So I think there's a big comeback in the employment sector. So I would probably make the odds of a recession about 40 to 50% at this point, which is actually a bit more optimistic than a lot of people I know.
Okay, and if we look forward at 2024, I know we just had the Fed make its cut, but now everybody's wondering what they're going to do next. And we did get the updated dot plot, and I think it's looking like there's an additional 50 basis point of reductions coming this year. So does that sound correct to you? Is that how you think it will play out?
Well, the dot plot is more aggressive in terms of rate cuts than it was at the last release. Yet it's still well behind what the market is pricing in. So something's going to happen there. Either the Fed is going to cut more, or the markets are going to reprice for a not quite as many cuts, not quite as loose of monetary policy as they're factoring in right now. The key there is that it's not just Fed funds futures that are pricing it in. It is the U.S. stock market, the broader bond market. Everything else would have to be repriced if the Fed adheres more to their dot plot than what the market's pricing in. I would lean more toward what the market's pricing in right now. I think we're likely to get a more lenient monetary environment than what the dot plot is predicting at this very moment.
I want to go back to the debt as well, which I know you brought up earlier, but we usually check in on what's going on there. And I know it's a big concern that you follow quite closely. And so if we have rates coming down, that reduces the interest paid on the debt. But I just wanted to check in, I don't think that really does very much. So any thoughts you would add on the debt situation?
No, even with a half point cut, we are about 1 percentage point, or about 100 basis points away from cuts that would make any real dent or slow the acceleration increase in the debt service payments. So as it stands now, we are paying about 1.1 trillion a year in debt service payments, and that will likely rise if the Fed doesn't do anything, or even if they adhere to their dot plots. That will continue to rise to about 1.2 to 1.3 trillion a year over the next fiscal year. So it's still a very bad situation, a dire situation, because every dollar that we are paying in debt service has to be in turn borrowed, which then in turn increases the deficit, which then in turn increases the debt service payments. So we're in a classic debt spiral in the U.S. right now. Now, as the issuer of the world's reserve currency, we can endure that far longer than any other entity on the face of the planet. But at some point, those numbers matter, and they're really getting out of hand right now. So it's to the point where even the mainstream financial media is taking note of it, even though you and I have been talking about this for literally years. It's now to the point where it is a real issue. And part of the reason why I think we've seen money across the board be allocated fractionally, but still very significantly toward gold and metals and miners, is a realization that neither presidential candidate in the U.S. is going to do anything to address that situation. And in fact, their policies are only going to exacerbate the situation. So that reality is setting in around the world, and it's the kind of reality we're going to have to live with for the next 4 years.
Yeah, this is a conversation that I seem to be having fairly often right now as I ask people, what is the election going to mean for gold? And people are, in general, kind of saying a similar thing of like, well, nothing, neither of the candidates is going to address the debt. So that's going to continue. So, yeah, definitely. It seems like it's on more and more people's minds, even in this sector, than it already has been.
Yeah. In other words, it's not going to, the situation is really bad right now. And there's nothing that the election is going to do that's going to help it in any way, no matter who wins. So, yeah, it doesn't look good unless you're invested in gold, silver, and mining stocks, in my opinion.
Okay, and let's definitely talk about the gold price and what it might look like moving into the rest of the year. So, after that Fed rate cut, we had gold really initially spike up, got almost to 2,600 per ounce, I believe, and then came back down. So, I'm curious what you think is going to be coming for gold. I remember we talked back in the summer about, the question of is the rate cut priced in for gold or what might be happening. So, any updated thoughts?
Yeah, well, it was being priced in. If you look at the charts, not only of the dollar, not only of gold, but also the dollar index and stock market, et cetera, it seems like investors started pricing the pivot around the 1st of July or early July, thereabouts. If you look at gold measured against or plotted against the dollar index, it is almost a perfect inverse correlation since early July. So there's a long, big story behind that, but it's all part and parcel of the Fed pivot monetary policy being priced into the markets, and gold in particular being driven once again by Western investors as opposed to Chinese investors and central banks. Now, going forward, I think that what's going to happen is the markets are going to price in gold specifically, continued rate cuts, and try to reach out there and feel ahead to whatever the Fed seems to be seeing now that it's being so aggressive in its rate cuts. So I don't think this is the end of this move in gold. I think it's going to continue because the baseline factors like real interest rates are going to be falling very quickly from this point forward. And that is an environment that's very bullish for not just precious metals, but all commodities. So I think the winds are finally behind gold. The fact that this event has been priced in somewhat, I don't think it's going to have as a detrimental effect on gold going forward because these other factors like the debt are still out there and only getting worse.
Do you think you can talk a little bit more about that shift from east to west? Because that was also one of our topics of conversation during the summer when we were talking about what had kicked off gold's rise in the first half of the year. It was Eastern central banks and also just regular investors who were helping drive the price. And now we're seeing that shift. So anything to add there?
Yeah, it was a unique phenomenon, a unique combination of drivers for gold for the first few months of this bull market that began right around the 1st of March. In that central banks, which weren't too price sensitive, were buying hand over fist, and Chinese investors and savers were buying gold, uh, coincidentally and fortunately for gold investors because their stock market and their real estate markets weren't doing very well. So they bought gold and they actually followed the price trend up. Chinese demand has historically fallen off as the price has risen because they're more price conscious investors and savers. But they didn't. They bought more as the price went up and as the trend accelerated. But Western investors were not participating at that point because they couldn't project those factors going forward. They were somewhat alien to their kind of analysis. What they could project forward was easier central bank policy, a shift toward easier money by the Fed. So Western speculators started to take the handoff from these other buyers, and around midsummer, and they have been starting to price in easier monetary policy. That's the kind of a trend that they can understand and project forward a couple of years. Now, as part of that, we're going to see more volatility. We're going to see rushes into gold, and they're going to see the money flow back out and take profits, and consolidations, and then new rallies. So we're not going to have that luxury that we had early on in this bull market of just seeing the price rising day after day after day. We will have these setbacks that will cause us to check our premises and try to drive the weak hands out of the market. But again, the big factors driving gold are decades in the making, and they're not going away. They're only getting worse. So I don't really see a resolution to this gold bull market for years to come.
I wanted to ask you also about generalist interest in gold right now. And I heard you describe in a different interview the generalists as this mythical population of people, which made me laugh. So are we starting to see more of that group get involved finally?
Yeah, that kind of amorphous group of generalist investors that were all praying are going to come flooding into the market with open checkbooks has not yet materialized, but it's starting to get better. We did not see much influence from that group, however it's described, early on in this market. In fact, as the central banks and the Chinese were buying, we actually saw outflows from the big GLD gold ETF, physical gold ETF. That started to reverse again in early July. That's one of the signs that we were starting to get money flowing into the sector. And in recent weeks, we've actually seen as well GDX, the big gold stock index, start to respond and actually outperform gold. At the same time, we saw silver start to outperform gold. These are trends that are only about a week to 10 days old as we speak. So the signs are that they're starting to come into the market. And primarily that's being driven by the huge profit margins, operating margins by the gold miners. Even the worst of the gold miners are now at 50% margins on their product. And those kinds of cash flows cannot be ignored by the market. And it's starting to become the place to be. So money's starting to flow into the sector. It's starting to go down the food chain, not just from gold, but into the mining stocks, now into silver. And I think it's only a matter of time before it gets a little further down the food chain into the juniors. And I'm starting to see, at least anecdotally, some signs of that with some financings that are happening. I think that market's starting to pick up in the junior mining space. So I'm quite encouraged right now at the trends I'm starting to see. And it's important to remember that we don't need to see gold and gold miners become the next AI theme, or mania in the markets. All we need is a very small percentage of the huge amount of capital that's sloshing around the world's markets now to really overwhelm the tiny markets of the metals and the miners. So just a small allocation can really light the fire under this market. And that's all we need. And I think we're starting to see that right now.
Right. I think you covered the key question that I was going to ask, and that I know a lot of people have had this year, which is when are my gold stocks going to start outperforming the metal itself? So you see signs of that starting already, which is good to hear. And we'll be able to check back in on that when we talk in a couple of months. So it sounds though like there's still time if you want to get in and get exposure to this trend. If you haven't already, or you want to add to your position, you can still do that for the time being. Where are you focusing? I know probably you're fully allocated at this point, but any thoughts there?
Yeah, I am painfully fully allocated right now. I think we're starting to see trading volumes increase to the point where you can start to reasonably let go of some of the slower horses in your stable and try to reallocate some of the better ones. The quality will move first to companies with big resources and some kinds of, the established resources, likely with some economics already outlined on them, will be the first movers. And we're already seeing that. We're actually seeing a little bit of M&A activity uh, in the space. So I think I would always focus on quality, good teams, good projects, companies that you're confident will be trading for much higher prices 3 years down the road. And now with this new influx of money that we're seeing into the market, maybe making really big moves in the next few weeks. Um, all that said, I'm still a sucker for the exciting exploration plays. So I always have a few of those in my portfolio. But the safest and I think the surest, lowest risk area, and one that offers almost drill hole potential, are these really undervalued companies that have really big resources right now. The market is just primed for those companies to be re-rated really in the very near future.
Okay, and I just also want to make sure that we can at least briefly on silver. So silver is another one. We know that eventually it should follow gold upward, but it's not making the types of moves that people might necessarily want to see. So is that one where we just have to keep hanging on till we see a move in the silver price?
Yeah, and it that has been the case until really very recently. Silver popped, right back over $30 over the last week or so. As we speak, is dramatically outperforming gold. So I think we need to see silver get up to $33, $34, and of course the next big number of $35 to really break the chains that have been holding it back. And then I think we're really off to the races. But that alone is a very significant move. So it the place to be right now, I think, for the most torque on this move in gold is really the silver junior mining stocks, the ones that have silver resources. I think they are going to take off like we saw in the spring of 2020 when we had that tremendous move in the silver miners, and I think that's going to happen again.
Okay, I think that sounds like a good place to wrap up, but I'll put it back to you one more time and ask if there's any final thoughts you would leave investors with, either about gold and silver or other metals, or about the conference coming up.
Yeah, I think you need to be involved in this market. I think that it's taking off as we speak. We're seeing the kind of market reactions, uh, the kinds of charts that we want to see in silver and the mining stocks to kind of leverage. It's all confirming the bull market. We have fundamental factors of the Fed switching to an easier money environment. Everything points toward the real takeoff of this junior mining sector. And so you really need to be positioned. This may be your last opportunity. And again, the New Orleans conference in this kind of an environment is really the place to be. If there's anything that's agreed on in the world of investing that is an all-encompassing truth, is that in a metals and mining bull market, the New Orleans conference is the place to be. And this will be one of our biggest years ever, with one of our best faculties ever, if not the best faculty ever. So you really need to be here. It's going to be highly rewarding, and again, we have a money back guarantee. So come on down to New Orleans and visit with Charlotte, who will be running around getting interviews.
I will be. I'm very much looking forward to it, and we'll connect with you again there. 50th anniversary, very exciting. Thank you for coming on to give us the details there and to share thoughts on gold and silver. This is really helpful.
Thank you, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Brien Lundin. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.